Hello there. In this video, we will be talking about the behavior of variable and fixed cost. We will also be discussing the difference between contribution and traditional income statement. In this first exercise, we are required to find the cost behavior of a coffee stand known as Espresso Express. We have been given the fixed cost, the variable cost, and the number of coffees they served each week. But before we begin, let's explain a little bit of what variable cost, fixed cost, and total cost are. When we talk about variable cost, bear in mind that the total varies. With variable cost, the total varies, but per unit is constant. All right. So when we come to variable cost, the total cost will vary depending on the unit or the number of activities. But the unit, but the cost per unit is always constant. It does not change. In contrast, fixed cost, the total is constant. The total of a fixed cost does not change. It's constant, and per unit varies. Okay, let me onboard it here. Okay, so that's the difference. Okay, that's the simple difference that when you remember, if you remember, you can solve all problems. When it comes to variable cost, the total varies, changes. Okay, the total changes. Per unit is constant. Per unit does not change. Fixed cost, the total is constant, does not change. But but per unit changes. The total cost is sum of fixed and variable cost. Total cost is sum of fixed and variable cost. Now, let's go ahead and talk about this problem right here. So we have here with the coffee stand, in this week they served 2,000 coffees, 2,000 cups of coffees. Week 2 they served 2,100 cups of coffees, and here they serve 2,200 cups of coffees. Now, what is the fixed cost that will be allocated to 2,000 cost of coffee? Here, we have been given that the fixed cost is 1,200. So the weekly expense of a coffee, the fixed weekly expense is 1,200. And fixed cost as defined here, the total fixed cost is constant, does not change. So depending, regardless of the unit here, the total fixed cost will be the same throughout. It will not change. So we have the 1,200 here, 1,200 here, and 1,200 there. Okay, so the total fixed cost is the same. That the total fixed cost does not change. Wait, and when you go to variable cost, finding the variable cost, we have been given that the variable cost per cup of coffee is $0.22. Okay, variable cost per unit is constant, does not change, but the total will change. So variable cost will be the $0.22 here. Okay, the $0.22 that we have here. So let's go back, $0.22 times the number of coffee cups served. So that is the total. Now, here too will be 0.22 times the number of coffee cups served, which is 2,100. We come here, we do the same thing, 0.22, that is per cup, variable cost per cup, times the number of coffee cups served. Okay, so we can tell here that the total variable cost varies depending on the activities that happen or depending on the number of cups they serve. It varies. Now, total cost. Total cost, sum of fixed and variable costs. The total cost is the sum of these two costs. So here we will have equal to this plus the variable cost. Okay. To save you some time, you just drag it over and then it compute the rest for you. Okay. So these are the total costs. Now, average cost per cup of coffee served. Here, we are asked to find the average for the total cost. Okay, we were not finding the average for variable costs. If it were so, the book will be specific with average cost per average variable cost. But here we are finding the average total cost. Okay, so average total cost will be, we will select the total cost divided by the number of cups served in a week. So the average cost per cup of coffee served is 0.82 according to 2,000 cups served. Okay. In the next week, we'll do the same thing. We'll take the total cost and we'll divide that by the number of cups served. On the third week, we'll take the same total cost and we'll divide it by the number of cups served. Okay. Isn't that easy? That is easy. That is easy and awesome. So just remember always that variable cost, the total cost varies. Let me just write it here so you see. It changes. It changes. Here, per unit changes. Okay, per unit changes. So just know when it comes to variable cost, the total varies. Fixed cost, the total is constant, or the total is fixed and does not change. Okay, the total is fixed and does not change. In the next exercise, we have a problem here for a company that we are required to prepare a traditional income statement for the quarter ended March 31st, and also a contributional format income statement for the same quarter. Now, let's talk about the difference between traditional format and contribution format. Traditional format is the same thing you did in financial accounting. It's the same thing you did in financial accounting. It takes the cost of goods sold, the sales minus the cost of goods sold, that will give you the gross margin. When it comes to contribution format subtract all variable costs from the sales to give you the contribution margin. And then after that, subtract all fixed costs to give you net operating income. So the only difference is in contribution margin, you separate all variable costs from all fixed costs. Now let's go ahead. According to the problem we have here, following traditional format, we have the company has a sales of $150,000. 150,000 here. Cost of goods sold. How would we find cost of goods sold? We don't have a cost of goods sold here, but we have beginning merchandise inventory, and we purchased $100,000 of merchandise during the period, and the ending was 40,000. So we want to know how much was the cost of the goods that we sold. So we will take the beginning inventory, which is $30,000. Put it here, $30,000. $1,000 plus the merchandise purchased. Okay, so we have 30,000 at the beginning of the period, and we purchased 100,000. Purchased 100,000. But at the end of the period, we have merchandise left, $40,000 of merchandise left. So we subtract the 40,000, and then that is our cost of goods sold. Okay, meaning we had beginning we had $30,000 of merchandise, and then we bought $100,000. That makes it $130,000. But at the end of the period, we have 40,000 left. That means we sold 90,000. Does that make sense? Okay, let me just repeat it here and write it here. At the beginning of the period, we had $30,000. Okay, $30,000, and we purchased 100,000. We add 100,000, so the total will be this plus this. So we had 130,000 during the period. But at the end of the period, we realized that we had 40,000 left. That means we sold 90,000. If 40,000 is left, then means we sold 90,000. Okay. So with gross margin will be the sales minus the cost of goods sold. This is the gross margin, $60,000. Now here we will take all selling expenses and all administrative expenses and subtract it, or subtract the sum of it from the gross margin. So how much is all selling expenses? Good. So here we have another thing that we have to compute for. Okay, you realize that we have variable selling expense of $50 per each item that was sold, or per each ski that was sold. Okay, let me mark it here. We have $50 for each ski that was sold. That's variable expenses, variable selling expenses. The fixed is the same. Variable selling fixed expenses is the same. But here, if one ski costs $50, okay, what is the total selling cost? This is where you have to find how many units were sold. We don't know the number of units sold, but we can use the selling or the total revenue to find the number of units sold. Now we know that the sales is $150,000, and each unit is $750. So what we will do is we will take, let me write it here, okay, number of units sold. Number of units sold, we will take $150,000, and divide that by $750, and that should give us this divided by that. That should give us 200, and it's a number. Okay, 200. So that means we sold 200 items. Okay, 200 pair of skis. What we sold. So now the total selling expense, we will find it by doing, we have $50 times 200, that's the number of units sold, plus variable selling expense, plus the fixed selling expense. Okay, so we take the variable selling expense plus the fixed selling expense. That will give us the total selling expenses. Okay, so 50 times 200 plus the 20,000 here, plus 20,000. That will give us 30,000 selling expenses. Okay, we'll do the same for administrative expense. Okay, let me go back. We'll do the same for administrative expense. With administrative expenses, variable administrative expense has $10 here. Okay, $10. We will multiply that by by the number of units sold, which is with the 200. So let's take this $10 times 200. Okay, plus the fixed administrative expense, which is $20,000. That will give us 22,000. So total selling and administrative costs, we take this, we add these together, that will give us 52,000. Okay, so total selling and administrative expense will be subtracted from gross margin, which will give us 8,000. So net operating income, according to traditional format income statement, is $8,000. Now, let's go and find contribution format income statement. We'll do the same thing with the sales. Sales will be the same, 150,000. Okay. Now, here we will find all variable expenses. We have already computed cost of goods sold. So we'll go here, just select cost of goods sold and plug it in, and it comes down here. Variable selling expenses. Okay. Variable selling expenses. We know variable selling expenses, we computed as 50 times the number of units sold. So that will be 50 times 200. That's the number of units sold. That's $10,000. Variable administrative expenses, we also computed it previously. Administrative expenses, variable administrative expenses will be $10 times 200. Okay, $10 times 200. That will give us 2,000. Okay, $10 times 200 will give us 2,000. So the total variable expenses, we'll add all these together. Now, all these three together give us 102,000. Okay, so contribution margin for the end of the period is 150,000 minus 102,000, which gave us 48,000 contribution margin. Now, the fixed expenses, now we know fixed expenses from our previous exercises. Total fixed expenses is constant, does not change. So let's move on and solve it. Total fixed expenses, okay? Total fixed selling, we have total fixed selling here, which is 20,000. It did not change, so we put 20,000 here. Total fixed administrative did not change either, so we put 20,000 here, okay? Total fixed expenses, we add these two together, will give us 40,000. Now, net operating income, we'll take the contribution margin and subtract total fixed expenses from it. That will give us 8,000. So according to traditional format and contribution format, we both have net operating income of $8,000 each. Okay. Now, we have computed for the first one, the second one. Now, number 3, it says, what was the contribution? So let me underline the keywords: contribution toward fixed expenses and profits for each pair of skis sold. Okay, these are the key important words: contribution toward fixed expenses and profits. Okay, just circle this: fixed expenses and profit for each pair of keys sold. If you are someone who is very systematic like me, you will go systematically. So let's do this very analytical way, and let's go straight to those who are smart as well. Okay, now when I think of this, okay, I ask myself, okay, how much is the fixed expenses in total? Okay, so I find that total fixed expenses, we have computed it here. Total fixed expenses is $40,000 right here. Total fixed expenses. How much is per each pair of ski? Okay, how much is total fixed expense for each pair of ski? We know we sold 200 pair of skis, 200 pair of skis here. So I will take this 40,000 divided by 200 skis, and I'll have $200 here. Okay, 40,000 divided by 2, we have $200 here. And now, profit, I will take the profit to, what is the profit? The profit is $8,000 here. I select $8,000. For each pair of ski, how much is each one on the profit? I take this one divided by the number of units sold, 200. Okay, and I add them together. Okay, so I add expenses, fixed expenses per each pair of ski plus profit per each pair of ski. That will give me $240. Okay, that gives me $240. Now, this is what you do if you are very analytical like me. And the second approach, you can straightforward just take the contribution margin, which is $48,000, okay, divided by the number of units sold. That's 200 units sold. Okay, so divided by 200 units sold, that should still give you $240. So you can go this alternative way, which take contribution margin divided by the unit, or you can go analytical by taking contribution margin of fixed expenses and then the profit as well, and then you add them together. Okay. I hope everything makes sense, and I hope this has been helpful. In our next video, we'll be solving this problem. That's a high-low method and contribution format income statement. But for meanwhile, we have a problem here, and for the sake of time, I've already computed it. So feel free to pause the video and go through carefully and think about how these are classified into what they are right now. Thank you for watching this video. I hope this has been helpful. If you like it, please subscribe and also like the video and share with your friends that they will also benefit and love accounting class. Thank you. See you next time.